Hey everybody, I am Johnny from Harvey Goodman, broadcasting live at St. Clairsville, Ohio in our new podcast studio. Joining me today is Carrie Stinlge from Union Home Mortgage.
Hello. Thanks for having me.
Yep. Today we're here to talk about options, market conditions, things that if you're thinking of buying, selling, basically any questions, feel free to leave your comments or questions in the comment section below. We'll do our best to answer them in real time. So Carrie, thanks for stopping by.
Thank you so much.
So you brought a couple things to go over, and I had a couple questions for you in advance. So you want to tell the people, who you are, how you got started, your backstory, as far as how did you get into, mortgage lending?
Wow, I got into mortgage lending over 21 years ago.
Mm-hmm.
And I would say I jumped in mostly because the industry was really booming and there was a high demand for help.
Sure.
I actually started out as a notary, a closer, a processor, and then became an originator. So I've kind of experienced all aspects of the process.
So in your, time, as far as, you've encompassed multiple different angles of viewing the same situation. So if a problem comes up, you have plenty of experience. And we've always worked very well in the past. I mean, I trust you implicitly with my clients. So it's nice to know that you have that, because honestly, just until this moment, I didn't know that you did all of that in the background as well. So it's tremendous. So as far as the buying process, we just talked before going live about where do most people start? Do they call a lender first? Do they call an agent first? Do they kind of just go and shop on their own without contacting anybody? What is your recommendation about just getting started and entering the real estate market?
Buying a house is one of the biggest financial decisions someone can make.
Mm-hmm.
And the path to home ownership can be quite a journey. So I would recommend starting out. If they want to call you, that's first, and then you want to have them call me. You always got to know what you qualify for before you go making offers. So it's really good to talk to the lender, see what type of financing you qualify for, if you're going to need a down payment, how much money you should have set aside.
Precisely, yeah, and we were talking about that just briefly before as well, that all offers created equal on a monetary value. Just because you qualify for something doesn't mean it's the same path for closing. I mean, and when I refer to that is most people equate to, okay, I went and got pre-qualified for a lump sum, and they think that the dollar just spends the same way, whether it's coming from a government-backed source or a conventional source, or if it's cash, if it's a home equity line of credit, something that has collateral. Every single one of those, you might qualify for the same amount across the board for every type, but the pathway for closing is not the same. Isn't that, what do you see in your own experience?
Well, yes, it can be different, especially when it comes to getting the seller to accept when they're accepting offers. They're
Mm-hmm.
looking at where your money is coming from and what's going to be the easiest path for them.
Sure. Yeah, and that's right. I mean, no seller has ever called me and said, John, I want you to sell my house, but make it as difficult as possible.
Right.
No one ever does.
Right.
So to that extent, the seller oftentimes is influenced primarily by the price. If someone comes in with a very easy line of credit or a very easy offer, okay, here's a bag of money, it's a cash offer, but it's half the asking price, they're probably not as enthusiastic if it was a full price offer, but something that might have a little bit more finesse to work around to get to closing. Price makes all the difference in the world. But all offers created equally, at least in that monetary value. If you are a government-backed loan competing with a cash offer, you're probably going to lose because of the fact that you're giving the seller at least a little bit more difficulty to get that closed. So it's not just what you qualify for, but it's what type you qualify for. So how do you work with new buyers that come into your office and they just want to get started?
Well, we're going to take a look at several things to make sure you're ready. So we're going to definitely need to review credit. Credit matters. And when we review credit, we can tell what other monthly payments you have out there, whether it's student loans, car payments, credit cards. So knowing what other debt you have helps us determine your price range.
Mm-hmm.
We also need to know your work history. 2-year work history is always recommended.
Mm-hmm.
See what your income is. And assets. How much money do you have to work with? What do you want to put into this transaction?
Mm-hmm. Yeah, and knowing is the entire battle, at least in my opinion, because I get buyers all the time that will qualify online. I can go to Quicken right now and say, I'm going to qualify for a $10 million loan. I know I can. Because they're not necessarily doing the things that you would do as far as looking at all the basics. They're just saying, enter your data in here. I can get qualified under a fake name. I mean, it's really, with an online lender, they're not verifying my social. They're not doing anything. They're just taking what I give to them and spitting out a pre-approval letter that just says, go ahead and buy this. And then when the rubber hits the road and I have to support the documentation to give to them that shows that I can, support that kind of income, well, when I hand them my W-2s and they say, you can't afford a $10 million house, you're crazy, get out of here. They rip the carpet out from underneath of you. So I get buyers all the time that go to these online lenders and they say, here's my pre-approval, only to make a loan application, pay for a building inspection, get halfway through this, and they say, you know what, this one little thing, you haven't been at your job for 2 years. And they're denied home ownership when it's something that you do up front. And it saves so much heartache. It saves so much, especially financing. Imagine paying for a building inspection, title, and appraisal all out of pocket. I mean, that's over $1,000 out of pocket. And then to be told no.
Right.
I mean,
I never want that to happen to anyone.
That is brutal. Hey, Tim. Tim just sent us a message. Says congrats on the sold listing. So, yep. And we just had a closing together not too long ago. So
we need many more.
We need many more. So I guess the next step is, and I'm going through this. Tim, thanks for liking the stream. Once a buyer is pre-approved, and we talked about where they start from, whether they call you first or they call me first, but either way, it's truly talking to your professional first and getting that advice. And we try to send clients back and forth and make sure that, they're at least in the most appropriate place possible. Then once they find a house, they write an offer. What's the next step for you as a loan officer once you take over?
Well, by the time you're making an offer, I typically would have collected all your documentation and reviewed it to make sure that we avoid any potholes throughout the process.
Mm-hmm.
So once you get that contract, I need a copy of that contract. First thing I'm going to do is get you to sign your lock-in rate, get you to sign your application, which can be electronically, order an appraisal and title,
mm-hmm.
and make sure that, we're on the road to closing on time. Because some things take more time than others.
A lot of it, yeah. So when you say lock in the rate, this is something that I've had conversations with people many times. What do you mean by locking in the rate?
Well, the interest rate can vary a little every day, and it's been on an upward climb lately.
Mm-hmm.
So things to think about when rates are rising, and these are things I like to discuss with people that I have worked with and pre-approved. What you might have qualified for in January, you might not qualify for today, just because of the change in interest rate.
Yeah.
So we really can't lock in that rate until you actually have a property address.
Precisely, and this is, and I'm glad you mentioned that because that's what I was going to hammer home as well. Is that I even just made a 30-second video about interest rates and the Federal Reserve. So just in case any buyers are watching, money is typically lent from a government-backed source. The Federal Reserve is sort of like I'd call it the umbrella that oversees all this. And one of the 12 district banks across the country, banks borrow from those district banks and then they lend it out to people. You don't have to know the intricacies of how that works, but just know that if it's a government-backed loan, that's where the money's coming from. When the Federal Reserve says that they're raising the interest rate, that means that those loans are going to be, compromised by it as well. So they've said that they're going to raise it a total of 6 more times through the remainder of 2022. That was their own, not even more than 2 weeks ago. So what do you think the average rate, or what would you say? Because I get that question all the time. What do you see as the average right now interest rate?
Well, interest rates aren't really so cut and dry. It depends
Sure.
how many years are you planning to finance. Credit score matters, loan type,
Sure.
loan value.
Mm-hmm.
How much are you putting down? There's really a lot of factors behind quoting a rate,
Mm-hmm.
but the 30-year rates right now are 4.5.
Sure.
They're climbing.
And they've been as low as 3 or under 3 in the last 12 months.
Oh, yes,
Mm-hmm.
yes.
So people that were refinancing, I've seen a lot of that in the last 12 months, people wanting to take advantage of that and either they can keep the same payment and lower the amount of years they have left, or they can lower the payment and just keep the same amount of years, but one way or the other. But yeah, so the interest went within the last 12 months, like you're saying, is going up, and it's going to continue. Now, I don't think it's going to triple or double or anything. It's not going to be catastrophic. Even if it goes to 5%, it's still low. It's still something that you can take advantage of. Back in the 80s and even the 90s, there was interest,
Oh,
teens.
I can remember my parents being excited about refinancing to 12%, like in the 80s. Like, that was a great rate.
That's what happened with the ARMs, the adjustable rate mortgages, because we had to have something, because nobody had at that time 20% to put down, so they can inherit a 12% interest rate. That was the beast created out of necessity. We all saw how that ended with the market recession, the crash. Yeah, I mean, it take advantage of the opportunity while it's here, because, and I've pitched this to so many people that, buying everyone wants the best deal possible. No one ever says, John, find me the most expensive house. I want to overpay for my property, that kind of thing. It's just silly to even think. But the best time to buy is honestly always 5 years ago. Because if you look at the last 50 years worth of Ohio Valley real estate trends as far as housing, it's 2 steps forward, 1 step back. There's always a little bit of a dip somewhere, but it's always a upward moving trend. And as far as that, I don't see that going away anytime soon. Even with the inflation that's happening in the country, everything that we've been experiencing in the last 2 to even 5 years kind of thing, it's the housing market is still going up and up and up. So you want to take advantage of something. I don't think people really truly understand how important the interest rate is to their long-term financial stability. I mean, like you're saying now, someone that was qualified for, let's just say, $250,000 today, and the interest rate goes up a point, they might be qualified for what, $225,000?
Yeah, can make a difference.
It makes a huge difference. So it puts you in a completely different bracket. So, and not that I'm encouraging anyone to rush out and make any rash decisions that to that their search, but it's something that you have to know to at least be educated into. Maybe you want to be that competitive, but. So once we get the loan application started, you order the appraisal and the title order. What happens once the appraisal comes back?
Well, depending on the type of financing, so most government financing is going to require a home to pass HUD minimum standards. And you may have had a home inspection already done while we were waiting on the appraisal. Sometimes there's a few repairs needed for that type of financing before you can get to closing. And then as long as value is good, we're moving right along towards closing.
Yeah, so condition and value are the 2 biggest terms, at least from my side of the fence. And we get to be sometimes it's a good thing, sometimes it's a bad thing. We get to be the face, the real estate agents get to be the face of the transaction. So even if there's a low appraisal or there's an issue, we're the ones that people will call and say, how do I solve this problem? Low appraisals can be difficult because it puts everyone in that bind. There are things we can do as far as, like, maybe if the seller reduces in price, the buyer brings a difference, or there's a kind of a combination between the two. Maybe they meet in the middle somewhere. We try to do other review processes, such as like turning in other comps, seeing if the appraiser would have that difference of opinion, or if they would change their opinion. And conditional issues like peeling paint, it's as simple as picking up a paintbrush. I mean, it really is.
Absolutely.
With the interest rates being compromised, as far as the intention of them to be raised several more times through the year, the biggest thing that I've been advocating as of my whole script to a buyer has changed, because a delay in closing, if let's just say the interest rate's going to go up in 2 weeks, but we're delayed by closing because of peeling paint by 3 weeks, your interest rate could be compromised. So we need to be cognizant of this. It's more important now than ever because of those reasons. We need to be more aggressive to that extent as well. But what do you think?
Closing on time is important. It's very important to me, for sure.
Sure.
If something, we have a hurdle or something along the way, you can extend your interest rate, but that comes at a cost.
Exactly.
So that just means you could be increasing some closing costs, and you'd have to prepare for that.
Mm-hmm. And speaking of closing costs, so what's I have a general term for closing costs, but how would you describe it?
Well, closing costs are all the things we need to get you to the closing table, and that starts with the appraisal. There's underwriting, there's home insurance to think about.
Mm-hmm.
Usually, 9 times out of 10, somebody's going to escrow their home insurance and the real estate taxes into their monthly payment, because it's just easier than saving up to pay your tax bill every 6 months and your home insurance annually or whatnot. So we'll need a whole year of homeowners insurance in there. There's title fees, everything that the title company does to make sure there's no liens against the property. We've got clear title, transferred, recorded to courthouse.
And everything you just said, probably people watching scares people. That sounds like a lot. Oh my God, how much, you need all those fees paid up front? Well, the answer is no, you don't need it, because we can actually include your closing costs in the life of the loan. So, for example, if your closing costs totaled, if you had the appraisal and the title service and everything you just said, your homeowner's insurance, when we call closing costs, when we say closing costs, it is basically an all-inclusive term for all of these things put into one basket. Anything that is required of you to close the loan from the lender is going to be lumped together in that pool of closing costs. So let's just say your closing costs total $3,000, and you want to offer $100,000 for a property. Okay, make the offer 103 with $3,000 back in closing. The seller nets their $100,000, and your closing costs are included in the life of the loan for the next 30 years. It's easier to take a $3,000 debt and spread it out over 30 years than just bring $3,000 out of your own pocket. Now, you can do that if you chose to, but most people, even if you had the $3,000, I'd just say, man,
finance it.
Yeah, finance it and go save your $3,000, go on vacation. Do something that, more proactive. Buy a Bitcoin, buy something with it. Save your money. Right?
Yeah, I don't like first-time home buyers starting out broke either.
Yeah.
There's always that what if, and you should have a little bit of a contingency reserve.
Precisely. Yeah. So it's just something that's more, to me, it's easier. Unless if you're doing very well and you want to make, your own. To be honest, it's each individual's decision, but I always highly encourage it because it just seems to be the most pragmatic, way of using your money. It's your hard-earned money. You should hold on to it. So, and then the other side of that, you mentioned escrow. So for people watching, if you don't know what that is, escrow is basically just saying, okay, we're going to devote, let's just say a payment is $500 a month for, what would you say on 100,000? Probably 700, 750-ish, maybe around there.
6 maybe.
6, okay, yeah, I'm done. This is why you're a lender. Let's just say your payment is 600. If you say your portion of your payment is going to go to your principal, to your interest, and then another portion of your payment is going to go to taxes and homeowner's insurance. That means as the buyer, every time you make your monthly payment, a portion of that is going to be saved in a cookie jar, escrow, to be used at a later date to go towards paying off your taxes and paying your homeowner's insurance. Or in other words, you never have to touch a tax bill. Even when you get it in the mail, you can throw it away. It's already paid. It's paid out of your monthly payments, which is tremendously convenient. Because that way you can't necessarily forget about it. You don't have the sheriff knocking on your door saying we're going to take your property for back taxes, which again you'd have to miss it for multiple years at that point. But it's something that everybody should consider taking advantage of.
It also makes the lender a lot more comfortable to know that there's not a chance the taxes will become delinquent or a home will become uninsured.
Precisely, and it just when you're borrowing from somebody, from a lender, anxiety is the last thing you want to put in their chair because it makes your life harder as a buyer. It really does, and trust me. So, okay, the appraisal's back, everything's good, conditions are met, and we get a clear to close. So what happens next?
Once we have a clear to close, we're scheduling closing. You're reaching out to your realtor to make sure you know about getting utilities transferred, getting your closing disclosure to review to see exactly, make sure you're ready to go with what you're needing to bring to closing. Usually in our area, round table closing to get your keys at closing. So then, you get to enjoy your new home. Yep.
So basically, you as a lender, we get a clear to close, which means that it goes through, I call it the underwriting process, that's what we would refer to it as. And you can correct me if I'm wrong, but the layman's term that I always tell my buyers that the underwriter is this sort of nameless, faceless person that sits in the background, and all they do is they go through your file, take this whole binder of your appraisal, your title work, everything, and they get a magnifying glass out, and they look at it, and they make sure that no one cut corners where it was supposed to be cut, or everything fits appropriately. That way, no one's committing fraud. Once the underwriter gives it the stamp of approval, they send it back to you as a lender and say everything looks good, and then they issue the money. That money shows up at the closing table. It's not like you're not giving the buyer a check from you that they have to take to the closing table. It's already there for them on their behalf. They just go and sign their documents. We hand them the keys. Congratulations, you're a homeowner. It's really is that simple. Now, if you're doing these kind of things on your own, what do you advocate for people that aren't using, kind of for example, for sale by owner, if there's an agent that's not guiding that buyer in the background, how do you work with them?
Well, the process stays the same. And the process, as we may have just discussed, it sounds extremely simple, but there's a lot of things to consider during that time frame, which on average could be 30, 45 days, depending on different factors, because a lot really has to come together to make this happen. But there's things for buyers to think about during this process, once you're pre-approved, we really want you to kind of just sit tight and stay put where you're at. We don't want you to go out and buy a new car. These are all things that could steer you in the wrong direction or meet more hurdles, could delay closing. So like you definitely don't want to co-sign for somebody. You definitely don't want to open any new accounts. Don't want to spend your down payment prematurely. You don't want to go out and finance new furniture before closing. Any of these changes could really change your pre-approval.
Change jobs.
Don't want to change jobs. Yes, things like that. And opening new accounts. If you have new debt, now we got to wait for that debt to verify what that payment is and see if you still qualify even. It could make a difference in your debt to income ratio.
Yeah, I mean, we talked briefly about this as well before. I have a script that I tell my buyers: do not buy a car before you end up with the keys of the house, or else you're going to be living in it. And it's true. I'm seeing it, not necessarily a car, but I've seen other buyers go and get a credit card or go and buy furniture. And I've never had it to the point where I couldn't resolve an issue or work with the local lender, but I know others who have. I know others who have done. I remember one day that we were at a closing table. At least Scott, my business partner, was at a closing table, and the buyer said, "Oh, I'm getting keys today. This is great. I just got laid off. I can move over the weekend." And the lender grabbed the papers, shuffled them, and said, "We're not closing today." He ripped them from the buyer and just walked out of the room because they had to go verify employment all over again, and it caused it. And what he meant by that, he was a union carpenter, so he really wasn't laid off. They weren't doing the job that he was going. He was going to go somewhere else, but. Man, if he wouldn't have said anything, it's not that we want to lie to the lenders at all or anything of that nature, but once the job is done, it's like, we don't want you to go live in a vault and not live your life, but just kind of keep a low profile for 30 days, 45 days, because any little thing that you do, I mean, it could have massive consequence.
Absolutely. And if you're even thinking about it, I always suggest just call me. Let's talk about it.
Well, and that's what I always tell my buyer clients too, that it's when I do my job well, when you do your job well, people won't even know that we've done anything at all. Because if there's no conflict, people will just assume, oh man, that was really easy. You don't even see, like I used to have so much more hair when I started this business, right? It's one of those things that you and I probably, when we have a transaction, we're talking back and forth quite frequently. Hey, where's this person standing? What do we need to do next? What documents do you need? The buyer doesn't see any of that. They have no idea what's going on. Now, if you're doing that on your own, if you're buying on your own and you don't have the documents in order, you kind of have to step up to that and handle the role of what an agent would be doing, at least to that standard. Like you're probably not going to help them with the building inspection phase, or maybe you can give them a list of lenders. But if something comes up, I wouldn't expect that you're saying, "Oh, this is what you need to do to fix it." You're here for the lending side. You're not necessarily representing them through that whole entire process. Again, I don't know that, but so how do you handle that if something comes up during a independent borrower?
Such as an issue with a home inspection?
Home inspections, or just any issues in general, like with the contracting of it. Maybe the contract was missing some key details, or, if someone wants to breach a contract, for example.
Oh, yeah. I definitely don't write contracts for sure. And for sale by owner situations, the borrower usually, or the seller, one of them, sometimes the seller gets an attorney to prepare that contract. But usually, if something comes up, I'm going to do my best to resolve it, no matter what it is. I mean, sometimes people even get their contracts off the internet, fill in the blank. I mean, but still, that doesn't have all those little clauses in there to protect you that you as an agent are there to help with.
How many days do you have to do a building inspection? Mineral rights. What about post-possession? Are you selling your house to buy another house? And if so, what happens if the house that you're buying falls apart? Are you evicted from your current property? All these little intricacies that nobody ever thinks about. And I get calls daily. Oh my God, I'm about to be displaced from my house because this buyer is buying it, but I have no place to go now. The seller that I was buying from decided not to sell it to me. Well, did you know that that's illegal? What's it say in your contract to purchase? Well, I don't know. I just put it offline. You're making the single largest financial transaction of your lifetime, and you're going to, unless it's like doing your own medical servicing. It's like doing your own taxes. Certainly, you can do them, but if you make a mistake, you're the benefactor of all the consequences that come from that mistake. And again, I'm not pushing anybody in directions that they don't want to go, but I can't see myself just saying, oh, I got a broken leg, I'm just going to go home and cast it myself. I mean, it wouldn't make any sense unless I knew how to do that, unless I'm a doctor and, whatever, I had that specific set of skills. So again, not to discourage people from doing things on their own, but if you are uncertain in any way, shape, or form, consultation, you can call me, you can call you. I'm not going to charge you anything for a phone call. Neither will you.
Correct.
You're just getting some general advice, and we'll be happy to help. And if it requires us to get more involved, obviously we're more than willing to jump in and take over as needed. So, but yeah, I mean, is there anything else you want to go over or discuss? I mean, you've been tremendously helpful.
Is there anything else you can think of?
No, I mean, we went through the whole reasoning as far as, how to get things started, the path. We kind of followed this all the way down. Maybe one thing is, before we sign off here, we talked about differences in loans, like government-backed versus conventional. Do you want to elaborate on, what the difference is between, for each borrower?
Okay, so mortgage for residential property is my specialty. So I'm not doing commercial, just residential.
Mm-hmm.
And typically speaking, your loans are going to be conventional type financing, FHA financing, VA. The differences, like veterans, they don't have to pay PMI, they don't have to put money down.
Mm-hmm.
So that's a great program for our veterans.
Mm-hmm.
But again, the home has to pass inspection.
Mm-hmm.
And FHA is a great program. It's a little more lenient as far as credit and debt to income ratio, lower PMI premiums to help make a payment more manageable for our first time home buyers.
Mm-hmm.
Conventional usually requires a little more money down. If you don't have 20% down, you're going to be paying a little bit of PMI. That will be factored into your monthly payment.
Sure.
Those are the basics.
Yeah, so I lump them into two categories. Yeah, you mentioned FHA, USDA, and VA, which are the three big categories for basically what I would refer to as government-backed loans, or even first-time buyers. And then we have conventional. I think there's a little bit of a misnomer for first-time buyer, because you can buy 10 houses with first-time buyer loans, air quote, first-time buyer. The reason why I believe that they're referred to as first-time buyers is because the barriers to entry are really low. So you can have a lower credit score and still get financed. You can have, little to no money down and still get financed, because that's your first home. That's why they call it first-time buyer. Your conventional financing, when you refer to PMI, principal mortgage insurance. Some loans have it. VA obviously doesn't. It's an earned benefit from your service in the military. But conventional, once you hit a specific loan, debt to loan income, loan value, property value to loan value, once it's 80 to 20%, you can shut PMI off, which could save you anywhere between, probably 75 to 150 a month, depending on how much you financed.
Right.
And even more, depending on in some circumstances. So more people, oftentimes, at least in my opinion, once you use a first-time buyer, you own the property for 5 to 10 years. Usually people sell it about 7 years. That's the average. You've had 7 years, of market growth. You sell the property for that equity. Since you bought the house 7 years ago at 100, you might sell for 125. Some conservative math. So you have 25,000 in equity. You go and buy another property and you put that 25,000 down on the next property. That's usually what people do, and then they go the conventional route. So just so people, if you're watching this, you understand the difference between, when we say first-time buyers or conventional, you can use a conventional loan as a first-time buyer or vice versa.
You can, and sometimes you want to in today's market.
With the interest, yeah.
Well, it's specifically just because there's a shortage of homes on the market, and sellers can be a little pickier when in a multi-offer situation.
Mm-hmm.
So, yeah, I definitely like to go over all the options available to someone.
Mm-hmm.
When I first talk to someone, I just want to know their story. Are they in it for the long haul? That can make a difference in the type of financing you obtain. As a short-term plan, as a long-term plan.
Yeah, precisely. So,
and sometimes, like you said earlier, as a seller, a conventional offer is sometimes more likely to be accepted than a government loan that's going to require some inspections and maybe a few repairs to get to closing.
Precisely. And so making it as easy for the seller as possible. So, all right, well, I think that's good. We'll wrap it up here, and thanks for stopping by the podcast.
Thanks so much for helping or having me here. And if anyone needs my assistance, I am always happy to help.
I'll send as many as I can your way.
Thank you.
Anyways, everybody, thanks for watching. I'm Johnny from Harvey Goodman. We'll see you next time.